Welcome to The Explainer. Today, we are breaking down the latest earnings call from Amer Sports, and let me tell you, it presented a classic Wall Street paradox.
So get this. The company comes out, reports fantastic numbers all around, even raises its forecast for the whole year. And what happens? The market sells it off. The stock drops almost 5% on really heavy volume. So you gotta ask, what did Wall Street see that the rest of us missed in the numbers? We're gonna unpack that right now.
Okay, so here's the game plan. We'll start with those stellar results, then dive into what's driving all that growth. After that, we'll get into the big mystery, that disconnect between the company and the market. And finally, we'll wrap up with our take on what happens next. All right, first things first. Let's lay out the facts here. The Q2 results, they were by any measure incredibly strong. We're talking beats on basically every important metric. Okay, let's start with the bottom line. Adjusted earnings per share came in at 6 cents. Now, I know 6 cents might not sound like a huge number, but hold on. It absolutely crushed what analysts were expecting. The consensus was just 2 cents. They literally tripled it. And it wasn't just earnings. The top-line growth was just as impressive, maybe even more so. Revenue surged a massive 23% year over year. We're talking over $1.2 billion for the quarter, which just blew right past what everyone was forecasting. And here's the kicker. They did it profitably. Look at this. Adjusted gross margins expanded by 250 basis points. That's just a fancy way of saying 2.5%, which is a huge deal. They're up to almost 59% now. And this wasn't just a fluke. No, this was all part of the plan. A smart shift to selling more high-margin stuff directly to you, the consumer. So let's just put a pin in this for a second. The crucial point here is that this was a clean, solid beat across the board. They cleared revenue expectations by about 4%. Everything looked great, which brings us right back to that central mystery. If the results were this good, why on earth did the stock sell off? Okay, so where is all this incredible growth actually coming from? Well, if you listen to the earnings call, management kept coming back to one key idea, what they call their dual flywheel. And this really is the core of their entire growth story. This quote here from the CFO, Andrew Page, pretty much sums it all up. Think about it. You've got the super premium, high-margin Arc'teryx brand, which has just been a rocket ship, and now you're adding the accelerating growth of Salomon's sneaker business on top of it. It's a 1-2 punch. And boy, is this strategy working. Just look at the geographic breakdown, especially in Asia. The growth engine is absolutely roaring over there. Greater China, up 42%. The rest of the Asia-Pacific region, a staggering 45% jump. Just incredible numbers. So let's look at that first flywheel, Arc'teryx. It is just spinning like crazy. Their direct-to-consumer sales grew a really solid 15%. And get this. That's on top of really tough comparisons from last year. Their women's category is just exploding, up over 30%. And they're not slowing down. They're strategically opening up new stores all over the world. Okay, but then you have the other flywheel, Salomon. And it's like they've just shifted into a whole new gear. DTC growth was an incredible 28%, even faster than Arc'teryx. They're in the middle of this massive retail expansion in China, and their new products, they're really hitting a nerve with a wider, more fashion-forward crowd. They're seriously taking share in the global sneaker market. So you've got a clear beat and a powerful growth story. Everything looks great. And then we get to the twist. Because despite management sounding incredibly bullish on the call, the market just wasn't buying it. Instead, investors focused on 3 key risks that they think could derail this whole narrative. And this is really where you see the 2 competing stories. On one side, you have management painting this picture of incredible fundamental strength. But on the other side, you've got the market, the investors, and they're laser focused on 3 potential problems looming on the horizon. Okay, so let's start with number 1. Tariffs. Now, management was adamant about this. They basically said, don't worry, we've got this. They believe they can manage the impact through their pricing power and their global footprint. But for investors, that headline risk of a potential 30% tariff, that just creates this huge cloud of uncertainty that's really hard to ignore. All right, number 2, inventory. This one really jumped out, a 29% increase year over year. Now remember, sales grew 23%. So when inventory grows faster than sales, that's an immediate red flag for Wall Street. The big question becomes, is supply starting to get ahead of demand? Now, to be fair, management had a ready explanation. They said, look, this was a deliberate strategy. First, they pulled forward a bunch of their fall merchandise to get ahead of potential tariffs,
And second, they're using less expensive air freight, which just means stuff sits on their books for longer. They made a point to stress that they're very comfortable with the quality of what they have.
And then there's the final piece of this puzzle, which was a real surprise. The head of their Wilson brand, who'd been there a long time, suddenly left. And that just creates a leadership vacuum at a really key brand. Yeah, the company's CFO is stepping in for now, but still, it adds this whole new element of execution risk that wasn't there before. Okay, so that brings us to the verdict. We've laid out the strong results, and we've walked through the market's doubts. So where does that leave us? What does the future hold, and what's our call on this? Well, management didn't just defend their story, they doubled down on it hard. They went ahead and raised their full-year guidance across the board. We're talking revenue, margins, earnings per share, everything up. That's about as clear a signal as you can get that they believe this momentum they have is going to power them right through any of those headwinds the market is worried about. So when we weigh the incredible fundamentals against the market's fears, well, we're making our call. We are initiating coverage with an outperform rating. Yeah, we think the sell-off was a classic overreaction. And frankly, it creates what we see as a clear opportunity. It feels like the market is getting totally bogged down in these short-term risks, inventory timing, scary tariff headlines, while completely missing the bigger picture. And the bigger picture is this: Salomon emerging as a second high-growth engine that fundamentally changes the entire long-term value proposition for this company. So you might be wondering, how could someone actually play this? Well, one plausible idea would be a strategy that lets you benefit from a potential re-rating of the stock while still hedging against that tariff uncertainty, especially as we head into their Investor Day on September 18th. And of course, we always have to say it, this is not financial advice. And that's our take on what was a really puzzling, but ultimately very powerful quarter from Amer Sports.